Hello, everybody. This is Eddie Gabor, CEO and co-founder of Key Advisors Wealth Management. I wanted to shoot this video because here we go again. I'm getting a lot of questions because we've had a couple of names beat expected earnings and the stock has gone up, and they're asking, have I changed my mind? For 16 months, we've been bearish, and we've been very clear as to why we're being bearish. We are not perma bears. We are not perma bulls. We are a data-driven firm that lets the data dictate whether we're bearish or bullish. And our call has been for 16 months is that the economy is going to continue to decelerate, and we're going to see profits decelerate. We're going to see earnings growth decelerate, and we're going to see consumer get weaker and weaker. And this week, even with all the questions that we've gotten on whether we've changed our mind, the data confirmed what our concern is. Let's look at GDP, for example. GDP came in at 1.1%. Consensus was at 2%. That's a pretty big miss to the downside on a percentage basis. Not only was it a big miss, but they brought down GDP expectations throughout the quarter. And we still missed to the downside by a pretty wide margin on a percentage basis. So I tell you, after getting that data, our team sat around the table and said, here we go. We are going to see an even more acceleration in the second quarter, which is why we've been very clear with our clients and on national TV that we feel like in the second quarter, which we're in right now, is the start of the actual recession. And that's been confirmed, in our opinion, with some of the forward-looking data we've gotten from earnings that I'll get to here in a minute. Secondly is inflation is staying very, very sticky. That's the Fed's worst nightmare. The Fed has a very, very tough decision. They're in a worse spot than they've been in 40 years. We have an economy that is clearly slowing down. No one can debate that. And we have inflation that's saying sticky high. And we have a Fed that has repeatedly said they are not going to stop until the job is done, and the job they're saying is getting inflation down to 2%. So they have to decide, are they going to continue to raise rates and tighten policy at the expense of breaking the economy and the market to get the inflation down to 2%? Or are they going to pause or pivot early and risk a reacceleration in inflation? Look, we can only go off of not only the data, but what we're hearing. Chairman Powell has been very, very clear in his message. They do not want to pivot too early, and they are going to continue to stay higher for longer. That is extremely problematic, in our opinion, when you have an economy that's decelerating as fast as it is. So we don't expect to see any type of rate cuts this year at all, unless everything falls apart, because that's the only time they usually cut rates. Next is, let's take a look at credit default swaps. Credit default swaps on U.S. Treasuries have gone up by a pretty wide margin here. And as we go into the month of May and June, I think you're going to start to see a lot more attention focused on what they're going to do in regards to an agreement. What is the probability of D.C. coming up with an agreement before the 11th hour? We think that's very, very low. And the problem that the Treasury has is tax receipts this year are lower than where they were last year. And therefore, their window of when they potentially default gets narrower and narrower. Best estimate we can have is sometime between June and September, and I would say it's probably somewhere in the middle. Now look, do we think the U.S. is going to default on their debt? We don't. We pray that they don't, because we don't want to live in that world. However, do I think they're going to scare the market? The credit market is saying so. And we know the one thing that markets hate more than anything is uncertainty. And I think there's going to be a lot of uncertainty as we head into a very toxic environment in D.C., trying to come up with some type of debt agreement in a time frame that's going to really appease the markets. So we put a very low probability of that happening. Let's switch to earnings now. Look, I don't want to take anything away from some companies that had good earnings and their stock price rewarded their shareholders. My hat's off to them. But from a macro perspective, when we look at data, we don't just look at one or two companies. We take a look at the entire scope to come up with the overall consensus is. And the overall consensus is this. Companies have had to cost cut to get themselves in a position where they think they can meet expectations. The consumer spending is absolutely slowing down. Naturally, it has to based on where we are in the economic cycle. And we are seeing profits come in. These profit margins on some of these companies, even the ones that, supposedly were rewarded after their earnings call, take a look at their margin compression. You can only cut costs so much and do certain things to make your earnings numbers look good. But the true test, in our opinion, is going to be this second quarter because we think they've run out of ways to really be able to cut costs. So we think we're going to continue to see more and more job cuts, and you're going to see pressure on the labor market. And frankly, that's what the Fed needs to get to where they're trying to get to. Okay? So again, when we looked at earnings calls from the J.B. Hunts of the world, look at the transports, for example. Okay? They're signaling that there is absolutely a problem in regards to the economy. And again, it matches what we're seeing in the credit markets. So look, we have a yield curve inversion of the 3-month and 10-year at 1.7. That's a huge, huge inversion. At 50 to 60 basis points is when we get concerned. And it's more than double that to triple that now. We have earnings calls that have been very clear in regards to where they think we are heading into, forward-looking data. And the CPI data is confirming it. The inflation is confirming it. And on top of all this, we have a debt ceiling that we have to navigate through. Okay? So last thing I want to end it with here, with this. We've told our clients there are two places that we think we could be wrong. And if we're wrong, we're going to have to flip very, very quickly from being bearish to being bullish. One is if the Fed surprises us and recognizes the slowdown that we recognize and decides to start cutting rates. Again, I don't think there's a very high probability of that, but we'd be a fool to think it's not at least something that we need to be aware of because we think they've already over-tightened. So my opinion is they shouldn't be tightening anymore, but that's just my own personal opinion. So a rate cut would change our opinion in conjunction with a debt ceiling agreement that would come. That would cause an absolute euphoric moment for the markets, and anyone that stays bearish heading into that, again, I think would be absolutely foolish. But our game plan is very solid. We are, in our opinion anyway, we're continuing to be very bullish on treasuries. And we bought a lot of treasuries. We've been trading it. We're going to continue to buy dips and sell rips in the treasury market, especially on the long end of the curve. And we are not going to turn bullish on the equity markets until we get to a level that we think is worth buying. Because again, I want to make this crystal clear. Our opinion, as much as some people want to debate me on this, and I'm happy to debate anyone, is we're going to hit new lows before we hit new highs this year. And I think we're going to see it by the summer, okay? And look, this is a time-stamped recording. We'll see if we're right. And if we're wrong, we'll tell you we were wrong. But the data right now is not telling us that we're going to be wrong. And until that data changes, we're not going to change, okay? So I wanted to spend some time and share those talking points with you. Hopefully it helps you and your family navigate through this tough market. This has absolutely been a very, very gut-wrenching market to try to risk manage through and very confusing because of the mixed signals, okay? At the end of the day, focus on your process, the data that you trust to be accurate, and make it a winning week for you and your family. Thank you and have a great day.